is how on earth are we going to motivate homeowners to renovate? Well, there's one thing for sure. They will not be motivated unless there is a large amount of accessible, well-costed financing available. And that financing, to be desirable, should be available on every street corner. That means motivating retail bankers to really produce the products that will help us to finance the home renovation segment.
For the very first time, what this chart actually does is it breaks down and segments the 2 trillion euros per decade, totaling 6 trillion euros to 2050 of money that needs to be invested in renovation. The way we've created these figures is we've come up with an estimate for the average amount of renovation, 30,000 euros, assuming it's a deep renovation, without being too clever. And we've come up with the numbers of different segments of the population. So, and as you'll see, 40% of the top European banks are already using it. So we thought last summer that what would be a good idea was to go and do a survey of banks to see, this is, remember, last summer, a long time before the approval of the final recast EPBD. We wanted to see if banks were already implementing mortgage portfolio standards and if they understood what on earth that meant. So from a survey that we did with around 20 retail lenders, we saw that yes, 22% yes had a mortgage portfolio standard, 45% yes had been following the regulation and were preparing themselves for adoption of a mortgage portfolio standard. And as we think about the European Green Guarantee, which is the term used by Enrico Letta in his report to describe the new instrument that might fill the gap of recovery funds and replace some of the areas that have been available to us in the prior budgeting period, I think that part of that would be extraordinarily well used in a European instrument to level the playing field, to allow, irrespective of where you are as a homeowner, remember the 71% of European homes, to be able to access this extremely affordable renovation loan in order to provide you the necessary funding that you need to make sure that your property is safe, secure, energy secure, and comfortable and cheap to run.
Therefore, public funding can be the catalyst, but it cannot be addressing the challenge by itself. So it's not even close. Therefore, increasing the uptake of private investments is fundamental. There is the need to maximize the impact that the EU and the national public support for energy efficiency and for building renovation by making the most cost-effective use of these resources to leverage private investment. So this has been already mentioned very clearly by Czech minister and by Petr before. In that framework, collaboration and dialogue with the finance and the housing sector is fundamental.
Kind of all starts with the measuring of the emissions as a foundation, because financial institutions need to understand first what is their status quo of their emissions in a portfolio, that they are then able to take the next steps. But here, what we also see that partially financial institutions are a bit cautious because they're wondering, do we actually have the right data? We don't have the right data yet, so let's not start yet with the process. But what I then always say is, if you wait for the right data, you will wait for a really long time. And as you know, we don't really have that time. So urgent action is required to accelerate the decarbonisation action. So data limitations should not deter financial institutions from taking the first steps, from starting to assess their emissions and start this process.
So residential sector, member states have to reduce 16% of primary energy consumption by 2030. And they have to do 55% of the saving and 43% of the worst performing buildings. What does that actually mean? So there is a huge work of translation to actually understand, and this is not going to be very easy in all the member state or region. There we can help. We can help because even if energy performance certificate coverage is relatively light, there are many other ways of characterizing the building stocks. And we're now in 2024, we have AI, we have lots of digital mapping of buildings those actually do exist. So we have to crack this and to help characterize where those buildings to renovate are located.
And looking at their energy use and comparing it to the CRREM curves, the carbon risk real estate management, so which is perhaps one of the most successful EU-funded projects that have really put a scientific basis for what transition is for real estate property, whether you're owning it directly or in a listed or for mortgages.
Led and UN convened, and it has more than 140 member banks in more than 40 countries, representing 41% of global banking assets, which makes approximately $74 trillion in total assets. NISPA supports member banks to set, implement, and achieve net zero targets by providing framework and guidance.
Mortgage portfolios. So, as I said earlier, mortgage portfolios are a key focus area for the management of climate-related risks, and at the same time to provide required sustainable finance for the transition. We heard earlier about the volume, the size of mortgage portfolios, and I will throw some figures as well. In our statistics, we see that mortgage loans are about approximately 2/3 of the total household loans and 1/3 of the total loans to the real economy. So it is big in size. Now, I will move to number 4, fairly straightforward. As you already know, in the Pillar 3 requirements, we are already asking banks to disclose information on the energy performance of the residential real estate collateral in different energy efficiency buckets. And this is a very important information for the supervisors. And for this reason, as we are now working on the supervisory reporting, this is the reporting directly to the competent authorities, to the EBA, on a confidential basis. We are also going to ask this type of information because this is a very important information for the supervisors for the supervisory activities.
But yes, ING has been steering the most carbon-intensive parts of our loan book for a number of years now. Looking across carbon intensity metrics for shipping, aviation, other transport sectors, steel, cement, and also including commercial and residential real estate. So, in a sense, we have indeed had a mortgage portfolio standard for a number of years.
You have the main milestones of that journey. So the first work has been done within a French peers working group within the French Banks Federation. And we wrote a paper that describes how to compute the portfolio alignment, the mortgage portfolio alignment with Paris Agreement goals. It was published in July 2021. During that work, the main takeaway was the data gap. Okay, this is an issue that has been previously mentioned by colleagues from the previous panel and by other colleagues. So this is a big issue for this sector.
However, when you would have real data and when you have portfolio data model, then it helps you to estimate impacts. Dominic mentioned, for example, the EBITDA. And of course, we used our model in order to model also the impact of the energy of building performance directive on our model. And there you can see, of course, that this directive is much better than you would say there is no G or H business in the next upcoming years. But when you look deeper in the model, you see that by 2040, 2041, this is a little bit changing due to other grid effects. That means by greener energy supply, greener measures. Hence, one can say that there will be a need to foster regulation, and all what we do as a bank is, especially in the retail market, depending on.
We are doing a good job in many member states, but we have to admit that it is not enough. We need to triple of this figure. We need to triple the amount of investment that goes into the renovating buildings every year. we need to triple the number of individual investment decisions made by buildings owners. Just for a small country like the Czech Republic, that means 50,000 decisions a year.